Hi, Matthew. Good to see you. Just want to give you an update on Rupert Resources and about our ICRI project. Obviously, we put out our PEA the other day, so good to catch up again.
You did put out your PEA, and I'm glad we're catching up. I was slightly taken aback by the sheer scale of it, given you're only 3 years in. So why don't you just kind of give some of the headline numbers, and then we'll get into it, okay?
Yeah, look, I guess we're just really keen to get this out. I've been sort of frustrated as a fund manager not being able to talk about any financials. So, look, it's a first brush. It's like looking at the ounces we found so far. The new resource total for the project is in the order of 5 million ounces. The study shows we recover 4.2 million ounces. The NPV on that is 1.6 billion at 5% discount, and that's an after-tax NPV. And at $1,650 US gold price. And but the NPV is one thing, but what is absolutely demonstrated by the study and translated from the drilling is that the payback on this is like 2 years, and the IRR on it at 1650 is 46%. And then if you look at the sensitivities in the back, I mean, it's phenomenal. So that's what it's really about. It's trying to demonstrate the real value of the ounces we've discovered so far, and we haven't spent that much discovering them, and it's very early days into it. So it's a snapshot in time, and we're hopefully going to show how that can evolve.
Well, that's what I want to get into. There's two questions I had when I was reading through this. The numbers are obviously great. The market's reacted well. You're up, plus 25%, or settled at up 25%. You said this is the beginning, and this is a moment in time. So one, I guess, intent in terms of where you guys take this to, and the cost per ounce of doing so. But first of all, how have you done it? I know it's open pit, but which is cheaper than going underground. But what's the shape of this pit? I mean, how are you coming at it? Why is the AISC like $759?
I think, look, in the previous presentations, we've always shown this sort of like the long section of deposit and this sort of purple patch in the middle, and the fact that it's just one cohesive lump. I mean, when you drill, I'm up at site now, when you're reminded where you've drilled like 100 plus meters continuous mineralization and sometimes like 5 grams, and I like record hole like 8 grams. It's just one big lump of rock. So if you think about mining that, it's not a narrow vein that you've got to put loads of development and loads of capital in to develop it. You basically take the surface off, the till off the surface, and you're straight into it. And the strip, in the early years, you're moving 1.5 or 1.6 tons of waste for every ton of ore. Now that's just, and the grade of the material is twice the average open pit grade in the industry. So if you're pulling out stuff over 2 grams, so one of those tons are worth twice as much. And the other side of the equation is it's not costing you much to get them into the mill. And then the mill is super simple. We recover 95% of the gold, and the process to do it is absolutely very straightforward. And so all those things, just the pure simplicity. And this, we tried to get it across in previous discussions in himself, but it's quite hard on this until you put it on paper. And I think this is, there should be low cost ounces just because of the morphology of the deposit. And I think people always lose, when you're in this industry and you really understand it well, it's all about the shape of the thing in the ground that you're trying to get out, and how hard is it to get that to the surface. That's the main cost. And then it's how hard is its process, or how complicated is process. For this, both things are simple.
Right. Okay. So the geology, the geography, and the makeup of the open pit is working for you. Let's talk about the intent here, because circa 5 million ounces all categories, about 3.86 of that already in Indica M&I. But again, can you find more? Can you find more at those of these higher grade ounces that you're seeing? Because if I look at the NPV for recovered ounce is about 370, 380, that sort of level. What's it costing you to find it? Find these ounces?
$11 so far. So when we got to last September, we'd spent $9 an ounce. So in fairness, so in the last year, we spent a couple more dollars an ounce in terms of that sort of cost in terms of the project. But you've got a bigger denominator now slightly. So it's sort of looking about how much you've actually spent on the ground. And so I guess that's the key thing. You got to keep on thinking about how much it is costing you to farm more ounces. But when you've got that, when your spread is so far from like, even if you get up to 20 and your NPV per ounce is like 350 plus or 370 plus, I mean, that's why people invest in this business in the exploration stage, isn't it? That's why the returns are possible. But so many times you don't see those because the valuation on the ounces recovered is often a lot lower, as we've shown in many of the charts. It's to find something that's, often it's more like 200 or maybe $150 an ounce, whereas this is just exceptional in terms of the value.
Well, it is exceptional. Like 46% IRR at $1,650 gold, and a massive whopping 1.6 billion at BV5. It's very, very attractive. Maybe it's too attractive. I was talking to a CEO earlier this week and they're raising defense capital, money to stop people coming in and taking them over at this point. How? And I know it's a PEA, so it's early stage, when typically those things have a wide range of, plus and minus. How do you manage this going forward? Because obviously, if you think you can find cheap ounces like you've been doing, you want to kind of keep this thing going for a little bit longer, don't you?
Yeah, look, the aim is now, like we have, we've got the equipment on the ground. We're doing more drilling. We think, we're trying to find the extensions of Ikari itself, maybe the deeper in the east or just deeper below it. But then the guys are waiting for the ground to properly freeze over so we can do the Ikari North. We only discovered that 6 months ago. And this is the thing, Tom, my part always reminds me. He says, we found Ikari, the first base of Till hole went in like December, January of 2019, early 2020. We did the first diamond drill hole into it in March. And then in May, we released the results. So in like a 5-month window, you found, your life changes effectively. So we're still doing that exploration process. We've still got lots of targets. The team are pretty hyped up. And that's what we've got to do in the near term, is make sure we continue to demonstrate if there could be something else that can get into the next stage of the study, but also just, we're demonstrating like a 22-year mine life. I think it's 25 years the whole operation runs for. That's a huge amount of time from here to there. And as one of my geologists said to me today, he said, well, usually you only do this kind of stuff when you're in production, maybe 10 years in, you're still finding stuff. He said, we're doing stuff today to try and realize that value today rather than waiting until you're in production. We're trying to explore what could be there.
Well, and those answers get cheaper as you go forward, or the produced answers get cheaper as you go forward, because you kind of got those sunk costs over that kind of multi-decade period, that multi-decade investment. It only gets better. So with regards to you got enough money now. What's the cash position now?
37 million at the end of August, so maybe 30 million-ish now, I've been saying. Yeah.
Right, and then you kind of you put out your 6 months, 3 months, and 6 months numbers, and obviously the burn rate is that expected to carry along at the same sort of rate?
Similar sort of rate, similar kind of rate. Yeah.
Right. Okay. So you're good for 18 months or and beyond. 2023. So it's been difficult 2022. For most in this space, people have been cash constrained. How do you see yourself playing 2023?
Look, I think it's about, that was another reason to get the study out, because it gives you this foundation on which to go and raise more funds. And people say, okay, well, this is still the potential upside from this. So are you prepared to carry on contributing funds into the company? How much you raise just depends on the market, doesn't it? If you have a terrible market for gold and the shares are low, we can afford to raise a smaller amount of capital from our existing shareholder base and just have that flexibility in the business. We don't, say we are going to have to raise more equity, but it's about, you're not raising it on the back of just hope anymore. You're raising on the back of you have this really, really amazing business that you should be able to develop. So you're investing into that. So look, we just manage it, and maybe if the market's better and people realize the value of the project a bit more, we raise a bit more, I think, we have to work on the basis that we're trying to demonstrate that this is a really good business to invest in at all times. And hopefully, and put our best foot forward to investors and institutions, and be there to support.
Okay, and given the market background that you come from, is there such a thing as too big? Does it get to a point where there are fewer and fewer obvious takeover candidates or obvious buyers of this? And where do you think that is, and how close are you?
So taking a step back, the whole way we approach the engineering of it is to not, not look at the size, not look at the amount of ounces it produces every year, not even look at the total amount of ounces it produces over the life of the project. It was to look at optimize around net free cash flow after tax every year. Don't worry about the discount rate. You're trying to generate a project that's at least 20 years long, and then demonstrate how good those net free cash flows could be. Just like it was, and sort of take away the gold element of the business, just say, oh, this is a really good investment. And so, to go back to your question, it could be a lot bigger as long as it's generating these kind of margins. The question is, but we're not going to make it bigger for the sake of it, just to generate the same amount of money. It's about, mining's a challenging thing. I mean, but obviously a small mine is as hard to develop as a big mine, but this one's a medium-sized mine at this point in time. We hope to demonstrate that there's more ounces that could add to the life of this project. Let's not necessarily make it any bigger. It already makes $200 million of free cash flow a year for 6 years plus. So, I think it's a good size at the moment, and it's the realistic size that a company like Rupert Resources could develop itself. Yeah.
It's interesting optionality you've got there, but look, it's still just keep your feet grounded. It's PEA stage.
It is, absolutely. Yeah.
There's still a growth component to this story, so people looking in should be aware of that. Is there, and it's just, I guess one last one in terms of 2022. I don't think most people would have called the way it worked, but for you guys, what was the kind of the saving grace? Was it the ability to kind of raise capital and just get on with the business of developing your operation, or what would you put it down to?
Yes, look, we were fortunate. We raised money last year, and we raised a reasonable amount of money at a good time. And then Agnico followed their interest in their shares. They also exercised their warrants earlier this year. So we've always tried to put ourselves in a position where you're not restricted by the market effectively. So look, we're not going to wait until we've run out of money to raise more money. You need to have a decent balance sheet. We've got 30 people working in this company now. You need to give them some security, of job security as well. You don't want people to leave, so you've got to make it a good place to work. But it's always a balance, Matthew, and it's just, making sure that, we have sufficient funds in the bank that, we're not, that doesn't drive what we do next, ultimately. That doesn't stop us optimizing the project or having that flexibility. It's that, so, at some point you need to make sure you manage your balance sheet as much as you're managing everything else in the business on the permitting, geology, every side.
Brilliant. Look, James, thanks for the update. I appreciate you making time. You're in Finland right now, aren't you?
I am, yes.
What are you there to do? What's happening?
Catch up with the team.
Is Tom there?
Tom's here as well. We haven't been.
Fantastic.
Jeffrey's here. They're all up here. We're going to have a bit of a get together for Christmas on Friday night. That's our plan for this week. But really, just to see everyone and catch up. I've got a few meetings. We're doing some stakeholder meetings this week, and we have been doing those for the last couple of weeks. So, yeah, just
very good.
Finally, time to get back here after having my head in a PEA for the last couple of months. So it's good.
Good. Well, it's a great PEA. Enjoy your Finnish Christmas holiday. I did Christmas in Finland last year. Freaking freezing. The food was, well, an acquired taste, but the alcohol, they know how to do that extremely well. So I'll let you rush off and see the guys, and we'll see you when you get back to London, okay?
Okay, cheers, Matthew. Thanks for the opportunity again.